Well, good evening and welcome to this live stream on the 2nd of January 2024. It's Martin North here from Digital Finance Analytics. Great to have you on the show tonight. And we're going to do a little bit of exploration around investing and different asset classes and what's going on in the markets and all those good things. Very relevant at the start of the new year, particularly when we had that massive run up. Was it a Santa rally? Was it actually something else? Well, we'll hopefully explore that. Just before I bring Damien in, let me just remind you, as I always do, that we don't provide specific financial or legal advice. This is a general conversation. We do moderate the chat, but feel free to throw your questions and comments in. Always happy to take questions and we'll try and answer them. This is as at the 2nd of January 2024. If you're watching in replay, if you'd like to get my attention and specifically ask a question, if you use that Walk the World, that means that the questions get into my queue, which means that I've got a greater chance of seeing them. I've also enabled Super Chat, which means you can get your question to the top of the list, or indeed, if you'd like to make a contribution to what we do around here. We don't do this for profit. We do this because we think this is a really important set of conversations, and your support is always appreciated. So, having cleared the decks there, let me push this button and bring Damien in. Damien, hello. Happy New Year to you.
Yeah, and to you, Martin. Hopefully it's as I said, it's been wet down here. It's been nice to have a bit of a break, but it has the weather hasn't been particularly nice down here either.
No, it's really weird, isn't it? Because of course they were talking about very hot weather, when there have been periods of hot weather, but the amount of thunderstorms and the amount of wetness is just remarkable. And I was talking to somebody the other day who's actually had to move out of their place because they've just been flooded out again. So it's not good.
Yes. Well, we had a beach house for 10 days and not a lot of beach. But okay, we're back now.
I was going to say you'd be pleased to get back and back into the markets and what's going on. And I guess my first question to you, Damien, is what on earth is going on, right? So we had this massive run up in the last couple of months. In fact, if you look at some, I mean, here's the ASX 200, right, which is now pretty much at an all-time high. That's the Australian one. Of course, the S&P 500 also did the same too. So I guess the question is, what's driving it? Clearly, there was a change of momentum when Jerome Powell said, "Oh, well, maybe we won't be lifting rates, and maybe we'll be cutting rates." The markets have really jumped on that. Is it sustainable, or are we now at peak valuation? Is everything priced perfection? And I guess that's an important question as we come into the start of the next period in the markets, because volumes are pretty low at the moment, but they'll start ramping up now. So how do you interpret what's happened in the last couple of months?
Yeah, look, I mean, I think interest rates have got a lot to do with particularly the rise we've seen in stocks recently, and to be honest as well, probably the fall we saw in the couple of months prior to that was that I guess my characterization, and I've got a chart. Actually, I've just blown it slightly too big. I've got a chart that I wouldn't mind showing.
Yep. There you go.
If I just downgrade it to the right size. So I'm sort of looking at this as global stocks, the price to earnings ratio, the top sort of 1,500 odd stocks, which is largely gives you the market. And this is over 20 something years, 25 years. And so it's sort of showing the one on the right is my preferred measure. So the one on the left is everything that's all thrown in. I prefer to look at things in terms of evaluation, ex financials and resources, and not because I think that earnings aren't important for those sectors, but they are priced quite differently. And in particular with resources, what you find is that quite often when commodity prices run up, so oil gets to $120. And these things look really, really cheap because the earnings are really high and the price really hasn't moved. But what it's really reflecting is actually the fact that people are looking at $120 and going, that oil price isn't sustainable, so I'm not going to pay a top multiple. So I guess what I'm saying is a lot of the time for resources, high when it looks cheap is actually a time to be selling, and sometimes when it looks expensive is actually the time to be buying. So that's why I want to strip those ones out. And if you sort of look at the story, I guess you get from that is that the average is about 17 and a half times. So basically if you're buying a stock that's earning $1 in earnings, then you're paying $17.50 for that stock. And to think about it, you can sort of flip that around and get a yield out of that as well. So that and so we saw these massive PEs during the tech boom, where PE sort of reached sort of 20, 22 times or something like that, and much higher in the US. It sort of fell and sort of ran at that sort of 17 level for most of the last 20 years. We had this cheap part around the financial crisis, and then we had this expensive part where it sort of traded over 20 times again post the COVID, as we sort of came out of COVID and people sort of marked into that. Now, the issue with both the tech boom and where we traded at those massive multiples following COVID was there was a lot of growth factored in. So while multiples were high, so you might be paying 22 times on average for the market, but if the market's growing at 15% or 20%, then pretty quickly that number comes back down again. So yeah, I might be paying 10% too much for this, but it's if it's growing at 20%, then in a year's time now it's 10% cheap. Then we sort of had this period where we sort of went back to sort of more normal levels before running up, at the start of 2023, basically as earnings were falling off and we were still looking at high valuations still, to again 20 times earnings, which is sort of at the 85th percentile, say. It's sort of in the top sort of 15% of where we've traded. And then we basically, we shot down last year as people were worried about interest rates, got back to sort of closing in on average, and then we've just put a rocket back and we're back at that sort of 20 times earnings. So look, is 20 times earnings, is that terrible? Well, it's certainly in the top sort of 15% of where we've traded. And the question is, where's the growth going to come from? And that's the real key to this, is that if we were looking at a particularly strong growth period, I'd be saying, well, that's fine. If earnings were depressed or whatever, but earnings aren't really that depressed. We've certainly seen weakening earnings in terms of earnings growth, and it's pretty narrow. So there's been a small number of stocks, and 7 of them in particular, 7 of the really large ones, that have driven most, if not all, of that growth. And so, with that background, it looks expensive. It doesn't look priced for, when I say it's priced for perfection, no, if you added another 10%, I'd say it's a price for perfection, but it's priced for something pretty close to perfection at the moment. And so, and the risk is, disappointment on the earnings, and you could sort of see some bigger issues.
So I guess the question is, one of the reasons why markets moved quite substantially was the change in expectations in terms of interest rates. So I suppose the question then is, well, what happens if Powell doesn't cut rates in line with what the market is expecting? Because the market is now pricing a number of rate cuts over the next few months, particularly in the US, but also in Australia. At what point does the market then get shocked in the other direction if in fact they stay where they are rather than actually cut? And is that a significant risk, or is that effectively priced in? Yeah,
so I guess the way the thought process for how the stock market prices itself is that it's some sort of it's more based on the longer term rates than the short term rates. So if you think about I guess the classic sort of discounted cash flow model, which is effectively saying, okay, so if I earn $1 today, that's not the same as earning $1 next year. So $1 in a year's time is worth something less because there's inflation and risk and uncertainty and other things like that. So I need $1.08 next year or $1 today, and I'm sort of ambivalent towards it. And then you keep growing that number out in time. And so when we discount all these numbers back, it's just this future stream of cash flows. The $5 I'm going to earn in 2100 is actually worth very little today because there's so much risk and so much uncertainty and all that type of stuff. And so most people sort of tend to think about the 10-year bond yield as giving probably a better indication of what the stock market's doing in terms of how it's pricing, and that's what you typically see people using their models somewhere between the 5-year and the 10-year rate. And so the 10-year rate's done a fair bit of the heavy lifting already. So we were it touched off 5%, and we're back down at sort of, if you're talking US rates, we're back down under 4% now, and so a lot of that change in the valuation side on that 10-year bond rate has occurred, and so that's the number I'm probably more interested than what Powell is doing, and I think from a stock market valuation perspective. Now, if the stock market is looking at what Powell's doing, if he leaves rates higher for longer, and they're looking at it saying, actually, he's making a huge mistake. This thing's about to go into deep recession, and he doesn't know about it. Then we'll see that bond yield keep falling. But the flip side to that is, well, if we're going to deep recession, then earnings are probably going to get smashed as well, and so I probably don't want to be owning stocks. Right now, we're in this sort of the Goldilocks zone where earnings have been weak, but not so weak that you're concerned about owning equities. And the other side of it is but you've had bonds falling. So the bond yields are falling and giving you this valuation. So I've got a slide that might be worth showing. This is the forward earnings for the S&P, which is, there's good data on it. So it often gives a pretty similar view to if you're looking at global markets. And so the red line is showing what the 12-month forward numbers are doing. So that line just generally keeps rising over time. And actually, I just want to highlight as well, this isn't it's on a log scale, this one. So it's not, just to even things out a bit more. But if that red line's rising, then forward earnings are going up. When it's falling earnings are going down. Now, the flip side is the blue lines on that are showing what the year-to-year numbers are doing. So the last number is the 2025 earnings. This next one is the 2024 earnings. And the issue is each of the years have certainly over the last sort of 2 years, for example, these blue lines are headed down. So we've seen 2023 numbers basically we started at sort of 10 or 15% earnings growth factored in, and then it downgraded its way pretty close to zero. We've still got lots of growth forecast for 2024, but those numbers are coming down. And that's the real point now, is saying we're pricing in almost 10% growth for, actually, I think the S&P probably is over 10% growth. I think the S&P might be in sort of 12% growth or something like that. And so that's the real key, is will we get that 10% growth in the S&P? So if I look at actually, I haven't phrased this the way I wanted to, because I was going to tell a little bit of a story as well about coming back to these graphs to show you what's been happening in the most recent quarter, and then what's happening now. So if I look at Q3 earnings, and I've got a chart up here on the left, which is sort of showing Q3 earnings, and I've broken it out and said, okay, so we started at 100 and ended up at 3.6% growth for Q3. And so that's the actual number that came through. And where did that come from? Well, 4.8% of that came from the Magnificent Seven. So Google, Facebook, Amazon, Tesla, what else have we got in there? Sorry, Microsoft.
NVIDIA,
yes. Gave us 5% growth. And speaking, the companies themselves were coming in at sort of 15 or 25% growth, but of the total world, they contributed 5% of the growth to it. And then every other stock sort of detracted, basically, and you ended up with 3.6. And having said that, Japan was pretty strong as well. And then you look at, well, what's forecast for Q4, which is the one that's going to come in about a month's time. We'll start seeing these results. Well, we're forecast at 1% growth, and now it's even bigger. Even more of it's coming from that Magnificent Seven. So all the growth came last quarter from Magnificent Seven. Next quarter, even more so. You go to Q1. Now it's still relatively low growth. It's only 3% growth, Now it's starting to change though. So 3% is coming from the big tech, and another 3% is coming from every other stock in the US, and then all these other countries are detracting from growth. And so you're starting to say, okay, well, there's certainly some different forecasts for Q1. And then you look at the full year forecast though, and the full year forecast are basically saying, well, this is the world where we're going to get 9% growth. And it's basically saying, well, it's all going to go away. All that negative growth we saw last quarter, all the negative growth we're seeing in the Q4, all the negative growth we're seeing in Q1 is going to disappear. And by the end of the year, earnings going to be booming, and all these other stocks are going to be contributing all this growth. And that's where I think the danger is. So that's where I'm watching the closest. Why is there lots of growth forecast for all these other companies? I don't know. Is the answer? I look through. I spend a lot of time looking at what analysts are forecasting and what companies are forecasting, and it seems to be a fair bit of uncertainty. So what tends to be happening is in the numbers that are the most recent numbers, basically they're saying, look, we've got all these costs. We've managed to increase our revenues, but all our costs have grown as well. And so we're shrinking our margins is basically the story. And what the companies are typically saying, but that's starting to ease up. The cost side is really starting to ease up. We're starting to, and similar to what we're seeing in terms of inflation. And what we think is by the end of next year, we'll still be growing revenues, but our costs will be falling away. And so we're going to get all this earnings growth. Now, that's sort of on a individual stock, that sounds, maybe you can justify that. And you can say, yeah, okay, that makes sense and it adds up. The issue is my costs are somebody else's revenues and so on and so forth all the way up the chain. So effectively what companies are saying as a broad sense is, yeah, everyone else's revenues are going to fall, but mine are I'm still going to manage to keep my revenues up. And so, and that's where I think the disconnect has come, and that's where I think there's still earnings forecasts will still fall, is because, it is true that inflation's coming away. It is true that people's costs are falling, but it can't be true that every company manages to raise its revenues while all their costs keep falling away. And that's where I think the danger is. And so, so for me, this year is all about trying to find companies that can hold on to those price rises that they've put through. And they're going to be the quality companies. They're going to be the companies that have got these wide margins. And it's not going to be what I call the value stocks. They're the stocks that are selling commodity type products, things like cars and things like that, where, they earn these great margins while there's supply chain shortages and while people couldn't produce as many as what everyone wanted. But now that we're actually starting to see this flood come back in, they're the ones you have to watch out for, because you get the competition. If there's already a price war going on in China, we're starting to see that come out to other countries as well. They're the ones where I think you need to be very careful this year about how much growth is forecast in the companies that you're looking at.
And one question I've always got is that when analysts think about growth next year, my suspicion is that at the start of the year, they sort of put a trend in, right? And they look back and, and then over time, as the year progresses, they sort of tune their growth targets. So I suspect that the growth estimates are rather aggressive at the moment relative to what may actually play out, because, of course, reality will dawn.
Yes, absolutely. What tends to happen is people forecast 10% growth, and then and I say that it sounds like sounds trite, but actually, when you look back at analyst earnings forecasts, they almost always start at 10%, and then they cut one way or the other, and typically they go down.
Yep.
And then every now and again, you get some years where they rocket, and that's where it's a matter of trying to position yourself so that in those years where you rocket, you do have lots of exposure, and in the years where you think there's the most risk is where you sort of wind it back a little bit. So valuations on their own being expensive doesn't necessarily say you got to get out, but the mixture of high valuations and a concern about the earnings is enough to sort of say, okay, I need to at least be more cautious at the moment than what you typically would be.
Right.
And so as an example, like within our funds, when the market's pulled back, closer to average. We're still underweight, but we reduced our underweights, and now we're starting to wind that back and starting to look at where can we take the top off.
Right, because one of the questions I've got is bearing in mind that the bulk of the growth, certainly last year, was in that Magnificent Seven. The expectation is that they might not be able to do quite so well next year, although they might do well. So the assumption that the markets have is a broader base of growth, right? That's essentially what it assumes. Now, and
even more so, it's a reversal of so what's happening in Q4 earnings we don't know yet, but all those other stocks we've got earnings falling. Q1 the expectation is for the earnings to be falling, but by the end of the year they'll have flipped it 180 degrees and they'll have made up for the bad Q1 and average Q2 and Q3 and Q4 are going to be rippers. That's what's forecast at the moment.
Yeah,
and I can't see a good reason for it. Maybe it'll happen, and you can't rule it out. But it's hard to see what the catalyst for that is at the moment.
And how does the US election play into all this? Because of course we know that this year is the year of the election. There's some interesting research done as to what happens to markets in and around the election.
Yeah, that's right. Well, and this idea of the 4-year cycles, and that actually, where possible, that they'll try and manage the economy to manage the economy to keep it strong rather than in election years. If you're going to have some painful recessions, or you need to wind back and pull back on growth, do that in your first couple of years, and then err on the side of caution in those first couple of years, and then err on the side of, overstimulating in the last couple of years. And there's a couple. I'm trying to remember the guy. Somebody's written a couple of pieces on whether the Fed doesn't want Donald Trump in there. That they does basically the thesis they're running with is that Donald Trump has not been fond of independent institutions. Let's put it that way. And that, last time he tried to put somebody who wanted to go back to the gold standard on the and put some of the wacky people into the Federal Reserve Board. And so if they don't want him in there, they're gonna try and err on the side of the economy running a little bit hotter than usual, rather than being able to talk about a recession. This is all speculation, but there's, I don't know, maybe there's a grain of truth behind that.
Well, certainly,
I don't think it's anything that they discuss in the minutes.
No, I'd say it wouldn't be something that would be displayed in the minutes. But it's interesting, isn't it, that Powell seemed almost to pivot his views over a period of a few days, right? Because he came out and was basically continuing to say, well, we might have to put rates up, et cetera, and almost just over a week, 10 days later, he was saying, oh, no, we've probably, gone to a different direction now. And there was some speculation that, well, maybe there was actually a little bit of a political hand on his shoulder at this point, reminding him that there was an election due and interest rate cuts into the election would be quite helpful, et cetera, et cetera.
Yeah. Maybe. I think it as well. The data that came out over that time frame was and actually, I do feel as well. There's this is my speculation partly as well. Is that there is a reasonable amount of the market that's driven by trading by traders, and I think I've discussed before that I think it's useful to think about the market as being at one part of it is these people out there that are just trading money, and they're like, I don't really care which direction the market's going. I'm going to be buying stuff that's going up and shorting stuff when it's going down, and trying to make money and just in and out with those. And they'll do some quick flips between we're buying heaps, and then all of a sudden we're something happens in our momentum models, and now we're short all these things. And then there's sort of this middle range of people that's more like myself, which is saying, okay, we're trying to manage people's money across asset classes, and we're flipping between stocks and bonds and cash and other assets when we think some are overvalued or undervalued. And then your final, so we move them up a lot more slowly in terms of how we're positioned. In terms of we need the fundamentals, and then the final ones, which are your real high net worths, who and people who aren't managing to a benchmark, and they might be just saying, okay, well, if we don't own any stocks, who cares? Or we don't own, or if we own all property, or if we own all bonds, they're sort of like, we'll just move into it when the return looks good, or if we just go to cash, that's fine. We're not trying to beat the market. We're not trying to beat any long-term performances. We're just when things look good, we're in, and when things are cheap, we're in or out. And so if you think about from those types of perspective, it does look as if that bond yield, the short-term traders really drove that for that last little push up, which sort of probably depressed markets a little bit more than what they might have otherwise done. And there's sort of this feel that, especially from a lot of the technical guys, it's going to 5%, it's going to 5%. It's like, I've just got to touch that 5%. And then it pretty quick, as soon as it touched it, it pretty much, reversed and flipped it all back. And so I wonder as well whether there's a certain part of that last little rise in bond yields and fall in stock markets that we saw that was probably just those technical people flipping their models from, buy the crap out of this to suddenly sell it. And that sort of made, at the time, I think the Fed and some of the fundamental people was probably a little bit more comfortable in terms of saying, well, actually, we don't, if interest rates rose from 4% to 5%, the long-term interest rates rose from 4% to 5% by themselves, then we don't need to do any more. We don't need to keep raising rates if that's what markets are doing. And so the fact now they've come plummeting down again, and now that sort of, and in the US, and that sort of makes a difference to their housing market and things like that, that's sort of doing a lot of the work for the Fed already. So that idea, I think if interest rates were still at 5%, if the long-term interest rates were still at 5%, then I think you'd hear more about, we are probably going to be cutting rates. And if long-term rates, as I said, because they've come down so much, now maybe the Fed's sort of going, okay, well, we don't have to do as much in terms of that cuts because the market's already doing a lot of that for us.
Yeah, and of course, as inflation comes down, and it has been coming down even in the US, the real interest rate effectively then is more aggressive than it would be if inflation was higher. So by definition, it starts to put the genie back in the box, like it or not. So that was
actually an interesting one in China I saw come out. I should have actually brought that chart because I think the Chinese real interest rate is one of the highest it's ever been, or certainly a 10 or a 20-year high it's reaching, because they've got deflation. so their actual interest rates are quite the actual interest rate you see is quite low, and they keep cutting rates. But the real interest rate keeps rising because they keep getting deflation, which is sort of driving that the other direction.
Yeah, and so the inflation-adjusted interest rate is actually the critical one, and that's a very important fact. The other factor, of course, is that when those markets moved directionally quite strongly, there was a lot of dynamic electronic trading. So all the programs and all the systems kicked in, and we got to actually adjust. So that's one of the reasons why there are quite considerable volumes of transactions, and because of the volatility, allowed people to take positions and therefore to make money on the trades. It sort of, in a way, messes up the fundamentals in the market because you've got all these short-term dynamics. Now, some people will argue, well, that's great because it makes the markets, quote, more efficient. I'm not so quite convinced as that. I think sometimes it just creates more noise rather than actually anything useful.
No.
But maybe I'm old-fashioned.
I'm very much of the same view. If you feel like you're adding to society by buying something at 11 o'clock and selling it at 11:03, I don't know. I don't think that does. I'm in finance. I do think there's I do think it provides value in terms of allocating capital and things like that. But as I said, buying at 11 o'clock and selling 2 minutes later is not helping the capital allocation process.
No.
There's an interesting. I can't remember. I've got to find the graph of. I'll try and bring it on for next time. There's somebody who does GDP numbers and treats finance as a negative rather than as a positive. He's basically saying, if your banking sector just doubled its profits, well, that doesn't help your economy. That's just we're sucking more out. Exactly.
No, exactly. Well, there is an argument for saying that the financialization of everything has created a financial system that is now not fit for purpose in terms of actually enabling the real economy to grow. It's all about making the financial system grow. And that actually has a really adverse effect in terms of real investment in real things, et cetera, et cetera, et cetera. So, and I actually think there's some truth to that. In a way, we've got this financialization model now where everything is measured through that financial lens, and it's not necessarily good for ordinary businesses or ordinary households. But
no, well, where it encourages investment and genuine investment in productive things, then that's where that's capitalism at its finest. It's picking onto things like the internet or AI or railroads at the right time and things like that, and actually going, here is technologies that are sort of going to drive the world forward. We're going to invest in those. Now they inevitably go too far and end up investing too much at too high prices. But there's that whole process of even the going too far part often leaves us with it went too far, but it left us with better internet than we would have had than if it hadn't have happened, or better train line than what we have, or better whatever. Whereas so productive investment's great. It's the part where you end up in the non-productive investment. That's the part where, arguably is that same argument I used for saying financial markets should be a negative. Well, maybe social media companies should be as well. Maybe the extra time that people are spending on social media might be detracting from the rest of our lives rather than so. There's this reasonable argument there.
Yeah, well, not all social media is the same. I would argue.
That's right. Don't demonetize us, YouTube. Yes. Yes.
No, very good. Now you mentioned some of the sort of the international issues, China, and there are a number of international specters, if you like. Obviously you've got the conflict in Ukraine, you've got the conflict in the Middle East, you've got the Taiwan election and the issue as to whether China is going to try and integrate Taiwan. You've got some of the economic issues out of China. You've got the low consumer confidence levels in many countries around the world. And there seems to be also, I think it's more than half the world population is going through an election cycle this year, right? So, there are lots of externalities which, to my mind, we have to play into the thinking about how things might shape forward. So I guess to what extent do those macro pictures play into your strategies when you think about investing, or do you basically just wait to see how those events play out?
Yeah, I think the main one for me is trying to identify how important is this as an issue in terms of which sectors. So I think if you look at, say, Ukraine, there was obviously a lot of issues about the energy sector at the start. I think our view, and I've got plenty of stuff out there that we've put out there, was that the issue about would we run short of energy is like it'll get worked out. And effectively it did. Like the issue, there was a lot of talk, for example, about this. There won't be enough ships for the oil. The oil now needs to go, instead of going to Europe and only taking a week, now it's got to go all the way around to India and China, and from it's going to take a month or more to get from around that part, and it's going to add all this problem. And the ships, they can't do it profitably. And like going, well, an oil tanker carries, call it $100 million worth of oil, and if you can, and a ship would cost sort of $30 or $40 million. So theoretically, in China, Russia at the time, we were talking about saying, look, Russia could literally buy a ship, fill it with oil, sell it drive it over to China, and literally throw the ship away and still make money on the deal. When oil sort of hit $120, like money will flow to those, and it'll get worked out. And so for me, it's about trying to work out where that fits in, and that actually comes back in. And where I'm getting to with this is that comes back into one of these things that is a specter at the moment that's raising, which is the idea of there's conflict in the Middle East. They've started shooting at ships going through the Red Sea. A number of shipping companies are saying, okay, we're not going to go through that canal anymore, the Suez Canal. We're going to go around the long way, go around Africa, and that's going to add days to how long it's going to take for these ships. Could we end up in another supply chain issue? And at the same time as well, we have Panama as going through droughts, and so they're limiting the number of ships that can go through the Panama Canal. So the same issues happening over there, where you got to go around the bottom of South America instead of going through the Panama Canal. And so, could we actually see a supply chain crisis come up again, like we did last time? And I think it's possible. So I don't want to rule it out, but I do think it's less likely. Sorry, what did I? Excuse me. And the reason why is usually there's a couple of different reasons. One is supply chains are more solid than what they used to be. So we've been through a dry run. We've been through, not even a dry run, we've been through a much worse. We've already been through this massive supply chain crisis. People have now thought about, if ships can't get through this, what am I going to do? Where am I going to find it? What have I got? Do I need to have extra inventory? Where can I? So that's one thing that sort of helps. The other thing, though, is we had such high prices. There's this wave of new shipbuilding that's happening, and it's all coming on board roughly about now. We're just getting flooded with these new ships and all this extra capacity. And at the time, these ships were built when container rates, say, were $10,000, and now they're $1,500. And so, the prices have literally fallen, 80% plus from when these ships were first commissioned. So without these, without a sort of these anything in terms of the shortages, we're already going to see this shortage of this oversupply, and we're probably going to need to scrap a bunch of ships and everything like that to bring out capacity. So I do think there's first of all capacity there. Secondly, supply chain to be more solid, and then we are seeing demand for goods has fallen back a long way as well. So we don't have that same massive demand for goods. We've got deflation in most manufactured goods, around the world. So and lower oil prices, and so could we see a supply chain crisis coming out of that? Maybe. But I think the odds are that actually it's more likely to be that it'll mean there will be less excesses than what we might have otherwise seen. What are some of the other big issues we're talking about there? China and Taiwan is a massive issue. Look, it doesn't look imminent. Having said that, who knows? There's an election this year, of course. And one of the two parties is wanting to meander closer to China, the other one away from China. So that's why this, potentially has, whilst you say, the time frame is extended. There is a catalyst.
There could be a catalyst this year, which is worth keeping an eye on. And it's quite soon. Yeah,
that's right.
This year. Yeah.
And so I think I think from the way I think geopolitically is, okay, I need to keep an eye on that on the issues there. And as you said, if the anti-China party is the one that sort of comes in, there's probably a period of pressure of 6 to 12 months of seeing which way things are going to push. But there's it's a spot you need to be keeping an eye on. Is it something that you need to, for me, that you need to be selling right now? Well, look, we're already underweight stocks. We're certainly underweight China in terms of, the effects that are sort of coming out of China, and that sort of, even more stats out today showing that growth is just slow and just not improving, and so that's in our view that you should be avoiding China. Before, even without considering what might happen in terms of Taiwan. And so, whereas if we had a different, I might think about Taiwan more deeply if, say, we're the other way around, where we're like overweight stocks a lot and looking for China growth and trying to invest in China, then I'd probably be more concerned about something like that. So I guess what I'm saying is, for me, it's about looking at geopolitical events which will harm your current positioning in your portfolio. Is rather than looking, and it's a frequent mistake people make in investments is actually saying, okay, I've made an investment in whatever it is. I'm going to look for factors that will we call it confirmation bias. I'm going to look for things that will help tell me that I'm right, as opposed to saying, no, I'm looking for things that will tell me that I'm wrong. Because I guess if you're sort of, take Taiwan, for example, I look at that and say, well, I'm already positioned pretty much in the direction if something went wrong in there and China, trying to get crushed and we end up with with more issues. Well, I'm actually already positioned largely in that direction anyway because we're underweight stocks and overweight bonds. So it's not, so I don't have to be as worried about that as a case where something particularly positive will happen. Like I'm out there looking for things where what can go right that I don't think is going to go right. Where can this soft landing come from? Is my concern is. Whereas if I was in a portfolio where I was 100% equities all loaded up on resource stocks and looking for China growth to boom, then yeah, absolutely that'd be your number one factor that you'd be trying to get a feel on about what's going on there.
Yeah, interesting. And the Cookie Boy threw this one into the conversation. Hi, Cookie Boy. What happens if Iran joins the war? What will happen to oil prices? And of course, the risk is that the conflicts that are going on in the Middle East could expand into other areas of the Middle East, and that, of course, is another factor just to sort of take account of.
Yeah.
But again, interestingly, of course, the US is now a bigger producer of oil than almost anyone else.
Yeah, that's right. And so there's a whole bunch of things with that. I guess that my overall I guess the logical way of looking at this, and I don't want to say logic is, when it comes to geopolitics, logic sometimes goes out the window. But logically, to my thinking, Iran has pretty much already got what they wanted out of this. So they wanted to. So Israel and Saudi Arabia were looking to do a deal. The US is pulling back, or has been pulling back from the Middle East, and they were looking to do a deal where the US gave effectively more military support to Saudi Arabia. Saudi Arabia recognized Israel, and that is largely seen as the reason why we saw Iran encourage Hamas to time the attack, in terms of saying they wanted to see Israel overreact and they wanted to see dead Arabs, and that meant that then the man in the street would no longer support in Saudi Arabia the recognition of and more integration of Israel into it. Now they pretty much got what they wanted. They didn't have to expend any of their own forces. They've got Hamas and Hezbollah, Hamas in particular, and Hezbollah. Now they've got the Houthis that firing rockets and having their own ships shot down. If that was your plan in Iran, was to stymie the deal and to do what you can, you've done a great job of doing it, and without any risk to any of your own, or very little risk to your own troops. So so not to say that doesn't mean they won't take the next step. They're not to say the logic will play, but I do think there's that's sort of like an overlying factor. If Iran got involved, look, you're going to see a spike in the oil price initially. I'm not as convinced that it would be a long-term price. It depends on how involved and whether it turns into. Look, Iran doesn't have the military capability to maintain a particularly long war, I guess, and particularly, if the idea was that they're doing this to shut down, the Saudi Arabian oil. Well, the biggest buyers of Iranian oil is China and India, and they also buy a lot of Saudi Arabian oil. So, I guess the issue for Iran is when your two biggest clients are against you, shutting off the rest of that oil, it's obviously going to be harder for them to make that decision. So, not to say it won't happen, but I think the fundamentals, so to speak, are against that. And so, I would be. I am underweight oil. I've been underweight oil for a little while now, and we went pretty close to zero weight when prices sort of rocketed post the attack. But oil you can never tell, and so
yeah. And talking about you can never tell. One of the other interesting observations recently is that gold started knocking on 2,000 and is now sort of, it's sort of above 2,000 at the moment. This is the current gold chart. which is interesting because, of course, it's now back to levels that we've not seen before. Obviously, if you were to apply inflation, you'd need, I think, gold to be at around 3,500 to be, back to level highs.
But it'd also be nice to get a yield from it as well, wouldn't it?
Well, I was going to say, I was quite fascinated by this because quite a few people said to me, see, gold is finally taking off. And I'm thinking, well, hang on a moment. Let's see clear. You don't get a yield, right? In inflation-adjusted terms, it's still way down from where it was. Now, I know central banks are buying gold, and I know that, people say, well, have gold in your portfolio. But it still seems to me a bit of a lazy asset. Maybe I'm wrong, but that's why I see it.
Yeah. I mean, I think I would say the rise recently has been more about the fall in the US dollar than anything fundamentally changing in terms of the gold outlook. So gold's a number of different things. One of them, as you said, is a central bank asset. So the way I tend to think about gold is, it's the ultimate greater fool. The biggest buyers are central banks, and the biggest buyers, greater fool investor. I should explain that. What I mean by that is, I need to find somebody else who's going to buy this from me. So it's I can look at assets in stocks, and sometimes it's like, well, or a bond, and you go, at 5%, we're looking at stuff, and we've got some clients who are looking for sort of 6 or 7% yields in returns over the longer term. And it's gone, look, if you can take half your portfolio or a big chunk of your portfolio and get a 5% return on it and lock it in for the next 10 years, great. Buy these long-term bonds and forget about it. So you don't have to worry about the price as much because I'm getting that yield that I want. And similar with stocks, where you're like, well, this stock's growing and all that, and so if the price doesn't go up, but it just keeps paying me a dividend that keeps going up over time, well, I'm happy. Whereas gold, you don't have that. You have to find somebody. I have to find somebody who's going to buy this from me because it's not returning anything to me every year. So I'm only buying it because I think somebody else is going to pay more for it. And you go, well, who uses it the most? And you go, well, the biggest is central banks and investors. So jewelry fits somewhere down further on the list, and industrial purposes and stuff like that is way down on the list. So really, it's about what are central banks going to do and what are other investors going to do. As I said, central banks are interested, and partly because, or I'd say in a large part, there's this, we saw the Russian reserves get taken, and so some of the smaller countries and the less democratic countries are now more interested in buying gold assets than what they are, say, in putting it into US bonds, because if they do the wrong thing, which a lot of them are prone to doing, then they don't want their assets seized. And then investors. Yeah, now you're talking about investors. One other factor I do think that plays into gold is I do think it acts as a currency in a way, is a sort of the anti-US dollar in a certain sense. So when you're seeing the US dollar running particularly strong, then I do think that's negative for the gold price, and then vice versa. And so we have seen, as bond yields in the US, and as you said, Powell flipped, we saw weakness in the US dollar, and I do think that added into that strength that you're seeing in the gold price now. And that's why for how we look at it, in terms of investments, if you want to sort of run your own investments with Nucleus, you can do what's called direct indexing, where you sort of buy a portfolio, and then you can tilt to certain things, or you can tilt into some things, or you can underweight, or you can screen out other factors. And one of the factors we use for people is gold. And so you've got your choice between gold stocks, gold, the physical gold will trade through an ETF, but physical gold within an ETF, or and you can either do that hedged or unhedged. And I do think you need to make that decision when you're looking at those golds, is saying, okay, well, what am I buying this for? If I'm buying it for US dollar weakness, then I need to think as well, what's the Aussie dollar going to be doing while that's happening? Is that going to be offsetting the effects? And so, that working out not just the gold price in US dollars, but the gold price in Aussie dollars makes a big difference in terms of how you should be sort of thinking about that and how it all fits together.
Yeah, and of course, the relationship between the underlying gold and the various instruments that sit above it, that's about 50 times leverage, right? So there's more trading done in the derivatives and in the options and futures than in the underlying. So in a way, it's not just about the physical gold. It's about this whole superstructure of financial system that's built around it, and people, like we said earlier on, taking positions and trading it and using short-term movements to actually make returns. That's where the real action is in gold, in my view.
Yeah, you want, and that's why you get all the conversation about it. I mean, if you look at, say, something like coal or iron ore, it's much bigger in terms of the amount of actual physical use, but you don't get anywhere near as much discussion about what's happening, especially not in international markets. Most most sort of websites, US-centric websites, wouldn't have iron ore as one of their key commodities, despite the fact it is actually one of the biggest traded commodities in the world. And when you look at the biggest mining stocks, they've got lots of iron ore, but it doesn't get talked about because the financial markets aren't as deep. And as I said, it's an entertainment game we're playing for sometimes for those, and so it's about where can I get the leverage that I want, and where can I do the trades, and so.
Well, let's move the conversation forward, because there are some bigger mega trends which is worth thinking about, right, as we start the new year. And we're not just talking about the US election and things like that, but there are actually bigger picture questions and issues which actually are really quite important to think about, and probably the start of the new year is a good time to just pick some of those.
Yeah, that's right. So I do this every year, have a bit of a look, and I just wanted to sort of I'll throw up a chart which is sort of, I think, hopefully explains a little bit better what's going on. So I've stolen the Ray Dalio chart. He's using debt cycles, but it works for other cycles as well. Is the idea we've got these three charts at the top. One is this, it's called productivity growth on his one, but there's this underlying growth factor. And then we've got these short-term cycles where we go in and out of recessions. And when I say short-term, it's probably more medium-term ones, so over sort of 5 to 7 years. And then you have these long-term cycles that are sort of the 50-year cycles. And the issue is when you combine all three of those onto that bottom chart, that the where you are can be often hard to tell. Like that, what really matters is that line, that rising line going through, that these other ones are going to oscillate around. And you can quite often lose track of that. And so what I wanted to talk about is some of these longer term trends and those oscillating lines that are taking sort of 50 years to play out. And I just wanted to highlight that is going on. And so it's something to sort of think about how you positioning overall within your portfolios, because we are actually going through a few reasonable size changes. And so I've got 7 of these. The first one's rising inequality. And so we've seen the top 1%, you can measure this in different ways, whether it's incomes or assets or whatever it is. But there's been this rising trend towards inequality. And what that's meant is more and more money ends up in the hands of the rich people, and they tend not to spend it. They tend to invest it. And the bottom sort of 50% of people don't spend as much as what they might have done. And so what that tends to mean as well is we get this sort of stagnation, and you get that low inflation that we saw right throughout the 2010s, and even from 2000 onward, where falling inflation because and central banks always can't work out where the demand is and where it's coming from and what they can do on that front. So and that's a trend which I don't think is changing. I still think that's still headed in that direction. So I guess nothing sort of new on that front. Where there is a bit of change is demographics. So I've got this one called dependency ratios, which I think it's the and I've used the US just because it's an interesting one. Is that the baby boomers? So a lot of people sort of track the baby boomers. So this big cohort of people, they're all born in the 60s, and so that meant dependency ratios got really high. So you'd have dad was out at work, mum was often home looking after the kids, and a large number of kids. And so because the kids grew, that meant that one person was out working and having to cover more and more people. Over time, the number of children has been falling quite markedly. And we've got this rising old age dependency. That's the bottom 2 lines. So fewer and fewer kids. So that makes it, I guess it's more the money that the wage earner's earnings, doesn't need to go to as many kids. And on the flip side, though we do have rising old age one. And so we had that sort of 50-year period from 1960 to 2010, where dependency ratios fell year after year after year. There was more workers for the people that weren't working. That has changed, and we're starting to head in the other direction now. And we're actually starting to get to the steep part of this rising old age dependency, where every year there are now fewer workers for more people not working. And the people not working are less and less kids and more old people that will need certain types of support while they're as they age. And so that ratio, I guess what was this great tailwind to markets and earnings over that period is now turning into a bit of a headwind. And so anyway, keep that one in mind. Not sure. Hit me up with it as we go, Martin, if you've got any thoughts on these. Otherwise, we'll go to the next one.
Harry Dent talks about quite often the demographic trends, and he makes some significant observations how demographic trends are different in different countries. So China's probably very adverse, Australia less adverse, et cetera, et cetera. So it is important not just to look at the US, I think, here, but also to think about where other countries may fit in.
Yes, that's right. And that's a great point. So Europe looks the same except much worse. Yes. Japan's already terrible. China's looking like it's going to age faster than any population has ever done before. So China has reached this point where they've got effectively this same chart, except it sort of I feel like China peaked peaked or bottomed, however you want to call it, in the last couple of years. But their line's going to get steeper faster than anyone has ever seen because of the one-child policy. Yep. So they're looking way worse. And then there are other countries, but I guess from a global perspective, this is pretty true of most developed economies. Look something like this. Australia, as you said, looks better. And there's even some of the less developed countries that are aging faster than you might think as well. So just because birth rates have come down quite significantly in a number of those countries.
And the final point there was an interesting article I was reading the other day that suggested that whilst global population is still growing at the moment, it is likely to peak and then begin to trend down because of these demographic factors.
Yes. Yeah. Yeah. So, anyway, so it has been a tailwind for 50 years. The last 10 has started to become a headwind and potentially going to get worse. Similar one, female participation. So this isn't going the other direction, but the amount, it's certainly gone from, in the 60s, it was sort of 10 or 15% of women were in the workforce, and there's a whole bunch of different ways you can measure this, but that's sort of pretty quick. You spent 30 or 40 years of that growing significantly, but it really, in most developed countries, really has flattened out. And so, again, that's that. I don't think it's not going the other direction in terms of turning into a headwind, but it's something that sort of helped to drive that demographic change and improve productivity effectively over that time frame, or certainly measured productivity and wages and things like that over that time frame.
And I just may add something there. One of the reasons this is important is because if you look at, for example, mortgages in Australia and the income ratios, it's now assumed that there will be 2 full incomes to pay for the mortgage, not 1. And that is because there are more females, in families who are now employed. And in fact, when CBA did their modelling as to what housing affordability was, they actually assumed 2 full-time incomes from one household, which are an interesting observation as to how trends have changed.
Yeah, that's right. Now, it is worth noting that there are some countries where it's starting to reverse. So some of the Nordic countries, you're starting to go backwards a little bit on these numbers. And I guess the point for this is that I think I guess as a social commentary is the question is, are people working because they want to work or because they have to work? And that's the part is I think people do want to work more generally, but the question is, there might be people out there who want to work 3 days a week or 2 days a week or whatever it is to stay busy, but actually do want to raise kids or lifestyle or whatever it is. But potentially in some countries with high house prices, and certainly I think we spoke last time about some of Jared Minnak's numbers that look like it's it's basically forcing people to work to be able to afford these things. Whereas there's people who quite potentially would prefer not to work as much if they could. So, yeah.
Well, that's certainly what I'm seeing in my surveys, that there are more people looking for more hours because they've got no choice to try and make the income and expenditure balance better. They don't want to, but they have to. They're being forced to, in other words.
Yep. Trend number 4. Look, I won't go. We talk about rising debt all the time. There's a whole bunch of different charts. And that doesn't look like changing. Like we're still. I mean, maybe there's a flattening. I don't know. Maybe if you look at the glass is half full or half empty. I don't know, depending upon how you want to look at it. But to me, it looks like debts are still rising. They'll probably get it close to a level, but sorry, I've jumped the chart. But yeah, we're obviously we've been in this massive uptrend of extra debt, which when you increase the debt, basically you're spending more than what you have, and that part of this is the other side of that inequality part. Is that how do you convince people that if you for example, if you've got a person where you're saying, okay, in 1970 you could buy yourself a house and a car and a holiday house and raise some kids, and your wife could work 2 days a week at home, and you could do all that on a teacher's salary or a fireman's salary or whatever it is. And then you roll forward 20 years and that's no longer the case. But that they can afford to do all that from owning all these assets, but actually will give you enough debt so that you can still own these assets. It's just you have to have to work more, and your wife has to work, and all these other issues about whether you'll ever be able to pay that debt off and things like that. So if you keep lending the money out, you can sort of hide the problem for a little bit. And so so I do think there's to a certain extent this is the other side of that inequality argument. And so when we start reaching the end of that,
extend and pretend, right? So you make the mortgages longer. 50-year mortgages coming.
Yeah, I think we saw 100-year mortgages in Japan at one stage.
We did, absolutely. Intergenerational mortgages. And by the way, the debt trend, of course, is, as you see in that chart, public and private. And of course, one of the big questions in the US at the moment is the rate at which the Treasury in the US is putting more debt into the system. So whilst Jerome Powell is turning the dial down in terms of the quantitative easing that happened, although they've reduced about 13%, I think, of the balance sheet. The Treasury is going the other way and flooding the markets with huge amounts of public debt. And I actually think that the public debt question now is becoming more of a critical issue because interest rates are still a lot higher than they were. And my expectation is they're never going to get back down to the ultra low rates that we had, which means that the cost of debt in the public system is going to be a lot higher. Yeah.
And I guess the only thing, I don't disagree. The only thing I'd note in the public debt is that the interest rate change takes a long, long time to come through because they can issue 30-year and 50-year mortgages, particularly in the US. So, if you're an Australian and you have a 2-year fixed or 3-year fixed, and then it rolls off, you feel it pretty quick, or you've got your floating rates and you feel it pretty quick. Whereas, from the government, because they are issuing at different rates, it's a boiling frog problem. So I guess what I'm saying is,
yes, it's a long, slow problem. And if you look at the MyEFO, which was the estimate that came out before Christmas, they are expecting significantly higher cost of debt in the public system. They're talking about keeping the balance down a bit. We'll see whether that works. But the cost of the debt's a lot higher than it was, which sort of takes us directly on to the question of the tax take and how the tax take works, right?
Yeah. So and it's a part about going, if I've got whatever it is, half my debt is shorter than 10 years and half it's longer than 10 years, and interest rates have shot up so quickly, which they have, I'd have to wait, I don't know, 10, 15 years to get to the point where I'm actually going, okay, now I'm feeling the interest rates that were from 10 years ago.
Yes. Because
the effect is so slow on that, the issuance of those debt. So I guess where I'm getting to is public debt can you can feel that problem. You can keep seeing those debt numbers get higher, and interest rates are higher, but the government isn't feeling the pain because they're still paying the interest rates from 10 years ago.
Yes.
The next one, falling taxes. So, and I'm talking about corporate taxes here, actually what I'm really focusing on is corporate earnings. And so, if I look at the last 50 years, sorry, I've labeled this graph wrong. We've had average nominal EPS growth of a bit over 6%. So 6% earnings growth from companies, and which has been, it's a nice kick in. If you're getting a 5% dividend yield, or maybe internationally, this is probably more internationally, you're getting a 3% dividend yield and you're getting 6% earnings growth. Well, that gives you roughly 9% total return, and your earnings keep going up, and that's sort of thinking about how you've got your return over the last sort of 50 odd years. Now, so 6% is great. The thing is, about half of that came from inflation. A little bit less than half of that came from inflation. So 2.8%. So then 3.3 of it came from actual sort of real earnings growth. If you break up that 3.3, well, 1.3% of that 3.3 came from tax cuts. So tax cuts in 1980, tax rates, even as in the 80s, were the median corporate tax rate was close to 50%, and now we're pretty much close to 20%. So of the real growth you saw, more than half of it was from tax cuts, and of the nominal growth, almost a quarter of the nominal growth we've seen. And so the question is, how much longer can this keep going on for? Because if I'm looking at my earnings growth and saying, oh yeah, I'm expecting to get 6% growth every year, but if taxes weren't cut, then I would have only got 4.7% growth or 4.8% growth. And so it makes a difference to that, how much I'm prepared to pay for stocks, depending upon what I'm thinking about their longer term growth is. Now, tax rates are still falling. So we saw the Trump tax cuts come through. Maybe there's a little bit of backlash. I don't think so. Hopefully at some stage we might see that. And this is, keep in mind, we're talking corporate tax rates. I think, Martin, you had some points about personal tax rates, so I'll let you make. But when we spoke in the pre-show, but yeah, corporate tax rates are certainly falling and not looking like reversing anytime soon.
Yeah, and of course, what's happened is it's the balance of tax take has shifted very dramatically away from corporates, because there's a sort of a race to the bottom in terms of corporate tax rates, which first point is that a lot of the returns that corporates have been able to make is because the tax takes dropped, which means they're paying less tax, not because they're necessarily generating real additional income, right? So that's the first point. And you can't necessarily keep on doing that unless you take tax to zero. But the other one is, of course, that the personal income tax rates have gone much higher because the tax bands have been frozen. And in fact, this is the chart that is pretty amazing. So if you look at the income tax payments as a percentage of household income, it's actually grown much faster than the interest rate payments, even net interest rate payments or gross interest rate payments. So it's the tax take that's actually the most critical thing to understand as to why people are feeling particularly uncomfortable. And a lot of the hit is on the lower end of the tax bands, as it were. So in other words, a lot of people who already have got very tight incomes are now paying tax for the first time, or more tax, because the tax bands have been frozen. And this is a policy setting that's happening in Australia, it's happening in the UK and other countries too. And the problem with this is, of course, it's putting a lot of pressure very much on households. And the net of all of that is that the governments are effectively more and more reliant on maintaining high taxes for individuals whilst they hand out more to the corporate sector.
Yeah. And just to highlight that inequality part, if I look at the top marginal tax rates, they've followed this line down.
Yes.
They've come down from astronomical rates. There's something you got to 90% in some, post-war type rates. And they have dramatically fallen at the top end. So as you said, the average rate paid by people has risen, but the top end, the top rate of tax has come down significantly as corporates. Yeah, and that's partly why as well this falling trend is again what contributes to the rising inequality. So richer people tend to be the ones who own their own businesses, and so we've seen these falling tax rates personally and falling tax rates on the corporate.
And Cookie Boy asked about the stage 3 tax cuts, which of course are still programmed in to come in, later on. That will actually, again, benefit the top end, going back to that inequality issue relative to other people. So I think there's a big question here as to whether the tax strategy makes any sense at all, whether the stage 3 tax should come in or whether it should be tweaked. But again, the government's sort of committed before the election to do it. So, you wonder whether they'll just follow through anyway.
Yeah, I know. Wouldn't have. I mean, to me, it would have made so much sense to go when inflation is running hot. I mean, they've still got a chance to do it with inflation running hot, saying, "Oh, okay, well, we don't want to throw more fuel on the fire. Why don't we delay them till after the next election, and then, a couple of weeks before the election, then if they want to oppose them going into the next election, they can." It would have been very easy to delay. An excuse with inflation. Do you want to throw more fuel on the fire? But anyway. I'm not going to go there.
But it is an interesting observation that the tax take is very different now, individuals versus corporates, and corporates are able to muscle into governments and encourage them to actually take the tax rates down to ensure that there's international competitiveness, right? Whereas households have less ability to be able to sort of resist the tax machine, basically.
Exactly, but I think it's safe to say, at least if you're thinking about the next 50 years going forward, at the moment this trend certainly seems to be that corporate tax cuts are probably going to keep coming, but they can't keep coming at the same rate they have. Like we've already come from 50 down to 20. Like the effect of each cut now is smaller and smaller on the overall effect on earnings, and so you're just not going to see that same tailwind. It's still going to be a tailwind, but it's just not going to be the same level it's been for the last sort of 50 odd years. Trend 6, rising trade, or what used to be, it was a 50-year rising trade. Merchandise trade of percentage of world GDP went from 15% to 50%. Now that had fallen into that period, and there were wars and stuff like that going on. But we're clearly into a negative part now, and quite potentially with we're seeing trade sanctions and more going on with US and China, and so that what was a sort of tailwind does seem to be becoming a more of a headwind, I think, and probably I'm not expecting it to reverse back to prior levels, but I think probably expecting more rising trade is probably I'm probably more neutral on this in terms of thinking, well, there'll probably be a fair bit of reshoring, but there probably also will be a fair bit more breaking into different trade groups where you'll still have, Europe, US, UK, Australia, a lot of the more developed countries and more democracies, more trading with each other, and maybe some of the more authoritarian countries not doing as much sort of trade with each other.
Well, I think the BRICS thing is really interesting now, right? Because effectively the extent of the BRICS countries is increasing, although Argentina might not now join, but the others will. And that then looks as though it's a sort of a more fragmented trade model, maybe even not built on the US dollar as much, etc. So there are some big sort of trends there. The other is, of course, that whilst the OECD and the World Bank and everybody and the United Nations all talks about increased international cooperation, the truth is it's fragmenting. It's going backwards. And that means that the ability to trade and the trade barriers are going up rather than down. So this trend looks to me to be quite an important tipping point.
And as well, when you talk about the BRICS as well, like they're not best friends. Like,
no, that's right.
There's India's relatively close with Russia, but they hate China. There's not a close relationship between those, and there's not a lot of these models haven't been built on. They're not built on. We have a similar worldview. This is what we want to see: democracy and world trade, and we want to see this. It's not built on that. I guess a lot of the developed world part, and the US sort of.
It's basically built on US doctrine, isn't it? I mean, up until quite recently, all of those world entities were very much aligned to the US way of thinking, and that's now being challenged.
And now their common thing that holds them together is the fact that they don't want the US to be leading the way, and they want to try and but they've all got different ideas about how that's going to be, how that's come about, and even so, you go through all those countries. As I said, we spoke those ones. Brazil sort of swings between, have you got a leftist person in there, or do you have a hard right? It can sort of sit in either camp as well. So I think that certainly a trend that's no longer a tailwind. Could turn into a headwind, but certainly neutral, I think, is your best outlook in terms of that. And the last one is energy costs. Now, this is probably a slightly more controversial. My take is that I've got this chart on the left, which is sort of showing the cost of solar over a sort of 50-year time frame, and it's basically it's a straight line down. And so the reality was, 20 years ago, it didn't matter what the cost of solar was. Now it matters so much that it turns any prices close to zero in the middle of the day. So yes, it does. Yeah, we need storage. Absolutely, we absolutely need storage to keep the if you want to keep expanding in this direction. But storage is coming, and it's it's there, like it's being rolled out. It's still high cost. It's not yet at the stage where you'd say that the storage is going to. You can't look at solar plus storage and say that's now the best possible way out, the best possible outlook out there. But if you look at the prices we were paying for energy when the Ukraine war broke out, and oil prices shot up, and gas prices and coal prices, at that point, solar plus batteries was cheaper, definitely in countries like Australia, where with great solar resources, and even closing in on lots of places in Europe without particularly good solar resources. And so I guess what I'm saying with this is there's a cap that puts on in terms of energy prices. So you can't see, or I certainly can't see, coal prices going to $200 or $300 and staying there, because at $200 or $300, the economic impetus is for everyone to flip to solar plus batteries if it stays there for any sort of length of time. And so for me, it's about saying, energy prices will spike above these level, but this is this falling line that every year is just getting cheaper and cheaper and cheaper, and that you can expect that energy prices are going to trend down over time, rather than sort of rising or certainly they've been rising or going sideways for the last sort of 40 or 50 years, because we've got this one line. We've had this scarcity line going up, which is the sorry, I should be going in the other direction, shouldn't I? Yeah, scarcity line going up, which is the prices of the coal and gas and everything like that, and rising over time. And then we've got the solar one coming down, and so and they're meeting. So solar plus batteries coming down, and they're meeting, and so that's where I think that's a trend which will play out over the next sort of 50 years.
And that, of course, begs some very interesting questions, isn't it, about how we get about, how we heat our homes or cool our homes, all of those things, and to what extent the investment in the physical infrastructure that's required to bring the energy from where it's being generated, be it from solar or from wind, and getting it to where it's needed, because that's the bit of the investment which is, for me, the bit that isn't really fully being thought through.
Yeah, I know. And this is the part, look, I mean, this is the part I'm worried when I look at these, that there's a fair bit of vested interest that are stepping in here, because if you look at the gas, if you look at an electricity bill for somebody in Australia and break it down to where it's come from, I think it's over 50% comes from the transmission side.
Yep.
And the issue is we need different transmission. So we've got a lot of this transmission going to coal-fired plants in whatever locations. We need to send it out to wind farms or solar farms. And so it does look like we need it needs a lot of change. The other issue is, though, the solar power you can generate on roofs is actually, that's where you're using it for a large part. So there is a part about over time transmission should be a lower proportion. we've got this problem. We have to build out this different transmission, but over time we should be able to generate more power right near where it needs to be done. So I think that's a I don't know. In my mind, there's it makes a lot of sense to generate solar on people's houses or as close as you can get to people's houses. It makes more sense for people to have a community battery for me than what it does to have individual batteries. And I think if there was a concerted push towards community batteries, that would actually bring the prices even closer to where we are. Because if you think about saying, if I can, energy's got this weird factor in most of the old one, in that the bigger you get, the more efficient it is. So if I put a motor on a car, I'm way less efficient than building one gigantic motor and shipping out electricity. But then I lose stuff. I lose electrons on the way, and I have to build transmissions and all that type of stuff like that. Or if I build a small coal-fired power plant, in a train, for example, it's way more expensive than a big coal-fired power plant somewhere and running trains on electricity. Solar and batteries don't actually have that problem. Wind is similar. Wind, the bigger the windmill, it gets way more efficient. But solar is actually pretty efficient. Like the actual efficiency drop is it's just adding more. It's effectively the same thing, but it's adding more. So you do get some benefits when you build lots of them. But actually, a lot of it is the sort of modular nature of solar and the modular nature of batteries in the same way is actually quite unique relative to a lot of these other technologies, and it is actually sort of an underplayed look at why they are important technologies. And there's actually, it's a left field thing. It's worth keeping in. I guess one more factor though, that there have been some interesting breakthroughs in fusion technology as well this year. Now that's a long way away, but before this year, it looked a lot longer away. But there's been some interesting tech breakthroughs, and maybe sometime in the next 20, 30 years, you get some, even further impetus towards lower prices.
Absolutely. And, thinking about the way that the electricity bills are generated at the moment off the marginal cost of gas, which is nuts, right? And Australia has a particular problem. We have a problem in the UK too. It would suggest that if some of those changes were made, then the economics could change. But then those industrial players who are in the current mode rather than the future mode are going to be precisely those who are going to try and resist this to the last step.
Absolutely.
Right?
Sorry.
Go on. Well, the point is, preserving the current instead of moving to the new is actually what they're about, really.
Yeah, that's right. And the transmission, that's where I was saying with the transmission, I'm worried about the transmission ones because I feel like they're going to really push this whole idea of that we just need more transmission everywhere, and we need to build big solar farms, we need to build big wind farms, we need all this, and they need to be offshore, and we need to get the solar transmission because they make money off the transmission. Correct. Whereas maybe the answer is actually maybe we'd actually be better off with lots more household solar, some community batteries to soak it all up, which you don't need much transmission because it's coming from my house, it's going 300 meters down the street, and then coming 300 meters back at the end of the day, as opposed to saying, no, let's stick that out, 300 kilometers away and then bring it all the way into and have to build massive transmission lines to do that because we've got to try and force it all through. And so, and as well, like the community battery side, if you have big community batteries, then you can drip feed those things. Like you don't need as much transmission because, during the day, all the stuff's being generated locally and filling up in one direction. And then at night, when it's when it's being sucked out of the battery in one, back into the houses, you can be drip feeding from 300 kilometers from a wind farm 300 kilometers away, and you don't need to blast it with as much to fill it up.
Yeah, anyway. Interesting. So that's a fascinating tour of the big picture. That now the question, of course, then is how does it intersect with portfolio management and because
Yeah.
you've got to make returns over the next few months and years rather
That's
than
right.
50 years.
Yep.
So,
And I'm going to pick energy on this one, because this is one is that don't get carried, like these are there, but don't get carried away too much with them. You want to be in that direction, but don't feel as if you've got to rush out and do this. So, we're going to find there will be times, let's say we're talking about oil as a great example of this, is saying, okay, this is moved to electric vehicles and self-driving and all this stuff like that, and we're going to use less oil. Yep, great. But if we don't build enough, oil declines really quickly, and if we're not actually building enough, the oil price could spike, and it could spike high for a number of years if you're not actually out building enough. And so this is a long-term trend, and it's about saying, okay, well, for me, at oil prices of close to $100, yeah, I'm out. I'm looking for other things, and because there's so much oil that can come on at those prices. If we're talking about oil prices of $20 or $30, well, I still think we're going to need a reasonable amount of oil to get us through this transition. And people drive cars for a long, long time. That's, if every car flipped tomorrow to being electric, there's still lots of oil demand for the next 20 years. And so it's about sort of picking the levels and trying to work out where these numbers are and saying, okay, well, there is an investment case at all points on this. Sometimes it's a buy case, sometimes it's a sell case, but it's knowing that, okay, I'm because I can see this holding that line over the top. When I see the coal price rally to $300 on Ukraine and Russia going to war, I'm not out there going, oh, I've got to buy more of that just in case, in case it goes to $500. I'm saying, no, that's the time to be stepping back the other way or going short, and if the coal price was $20, then maybe I'd be interested, maybe I'd go, okay, well, there might be more of a case for buying it at certain points. But keeping in mind these are long-term trends. It's not something tomorrow. It's getting that oscillation around that and trying to lean into these as they're coming, but keeping those in mind. And I'll go next time I'm on, because I know we've run pretty late already. Next time I'm on, let's talk about individual stocks. One I will leave on the energy side is that, how do I want to play this energy take? For me, it's a little bit about, okay, when do I want to get into the producers and out of the producers? It's actually more about, for me, saying I want to be in the people who are doing the transitions, because regardless of whether you're building transmission networks halfway across the country, or you're unplugging a coal-fired power plant and plugging in a wind farm, or if you're building community batteries and things like that, there are people doing those services, and they're the ones which I think are actually a safer bet in terms of how I can get access to those. So people that are making these new transformers and the people that are doing the services behind it, they're the ones I want to get hold of. So which is different to saying I want to rush out and buy a wind farm or a solar farm, because the issue with a lot of those ones is I buy a solar farm today, or build a solar farm today. Martin, you build one next year. Well, your costs are lower than my costs, and so there's benefits there, and there's an economic price you want to pay for it. But the ones I'm much keener on is the service providers to this sector, in terms of saying it's a safer bet in terms of how I think you can make money from it.
Absolutely. Well, a couple of quick questions to finish with. Bossman asked, is there an ESG option with the fund?
Absolutely. Yeah. And so I spoke about the screens and the tilts. So you can screen towards, and you can screen stocks out, and that's available on our active and our passive. And the idea behind that is that we joke about beer and climate change. Is like, there's people out there who like having a beer, and actually, I would like to do something about climate change. Maybe I don't want any carbon stocks in my portfolio. Most ethical funds, if you're giving up one, you're giving up both. Like it's saying, well, you've got an ESG fund, and it's like, well, we're getting rid of tobacco, we're getting rid of gambling, we're getting rid of alcohol, we're getting rid of carbon, we're getting rid. You go through and they're just tick. They're all out the door, and so you're either in or you're out. Whereas what we've done, which is unique or quite different in the Australian market, is we say, no, you tailor it back to yourself. If you don't want carbon stuff in there, knock them all out. If you don't want, nuclear power is like, is it great or is it terrible? People have different views on it. If you think it's, the benefits outweigh it, then you can add extra nuclear power into your portfolio. If you think it's terrible and going to proliferate nuclear weapons and things like that, then you can knock it out of your portfolio. The idea is we're trying to give people back the choice themselves, back to choose what matters to them. Because for me, ESG is, you don't want a fund manager or somebody else dictating your ethics to you. You want them to be to your ethics, and say, yeah, back to how you look at a portfolio, not how somebody else does.
Yeah, I think that's very important. And of course, that transparency and flexibility is one of the reasons why we keep having these conversations, because a lot of other alternatives out there are more opaque, and you've got less ability to be able to shape it the way you want.
Yeah, and we just saw a bunch of ones get wrapped over the knuckles again. We just keep seeing greenwashing stuff all the time coming up from ASIC, and a whole bunch of super funds all got wrapped over the knuckles. And I think it was that ABC did a special on them, just sort of showing how all these guys that say they're ethical, and then you end up owning all these other ones. And then that was partly why I started this company. Was, one of my experiences was working with a fund who was an ESG fund, and they had a whole bunch of Woodside petroleum in it. And I was like, well, just a minute, you're an ethical fund, you're talking about carbon. How come you own Woodside? You're one of Australia's biggest gas producers. And this was in a global fund. Yeah. And the answer was, well, gas is better than coal, and it's better than better than some of the lignite. And so that's what's going in the portfolio. We haven't bought the coal stocks, but we have bought gas stocks. And we go, well, most people buying an ESG aren't looking for saying, well, just give me the one that does that harms things, but just less than the other guys. They're basically saying, well, And so that was the idea that I want to give people that choice of saying, if you don't want something, knock it out. And we're not going to turn around and say, well, okay, we own some, but we didn't own the really bad stuff. So you should feel better about yourself. It's actually, if you don't like something, we actually genuinely kick it out.
Absolutely. And Cookie Boy asked why are bonds rebounding today? And I think it's two things. One, if we've just crossed over into the new year, and so people were portfolio positioning to the end of the year, and they will now reposition. Secondly, of course, the volumes are still quite low. And thirdly, maybe some people who were very extremely enthusiastic about rate cuts are beginning to realize that maybe rate cuts will come, but later rather than sooner. So I think those would be some of the factors that I'd pick on. Don't know whether you've got anything to add, Damien. But
there's probably a little bit of pendulum in this as well. I do think at 5% got way too far, and we in a month and a half we reversed all that, and quite possibly it's sort of swung a little bit too far. I do think over the medium term, I'm still not too bad on bonds. I still think there's a case for them. But the pendulum will certainly swing too far in one direction and too far in the other.
Yeah.
And
I would say to people, those term deposit rates that are out there at the moment, they won't be at the current rate, they'll be lower ahead. So if you're thinking about term deposits, it's probably a good time to look at those, because I think rates will come down quite quickly.
And keep in mind as well is that, and so this is ones, if you ever do want to buy government bonds sort of externally, like they're actually pretty easy to trade on the ASX. They're ASX listed. You should be able to buy them through your CommSec account. It's sort of like a term deposit that you can sell in the end. If you're looking at something and saying, well, I want to earn 4% for the next 10 years, and I'm happy with that 4%, that's all I need, then buy yourself a 10-year bond. 10-year government bond. We do some really cheap ones where we do like a government bond ladder where we just buy a dozen bonds and you just rotate them through. But the good thing with government bonds is you can lock in those rates for longer periods. And so actually, I was going to tell you what the 30-year ones are, but I can't remember what the 30-year ones are at the moment. And there are inflation-linked ones as well. So there's some out there that actually give you inflation protection as well. So the only issue with those ones, if you're ever buying those ones, is the yields are much lower. So what happens with those is you get extra capital. So you buy it at say $100, you might only get instead of getting a 4% yield, you might only get a 1% yield, but the value of your bond goes up by 3% every year. So you get your 4% out of it, but it's you get then capital rather than.
And you need to read the small print on how the inflation adjustment actually works. By the way, it's not necessarily retail consumer price.
No, that's right. That's right.
Anyway, Damon, I think we've pretty much run out of time. I will just thank Jason for his super chat and his observation there that the stage 3 cuts could lead to more division between the haves and the have-nots. And I think that's a broader theme that I'm seeing a lot at the moment in my surveys and elsewhere, that we seem to have this polarization going on within the community. And that's a problem. It comes back for me as to what the fundamental question of why is society there. It's not necessarily to create massive polarization, and yet politicians seem to me to be stoking at the moment. So that's going to be an important trend, I think, this year as well.
Yeah, absolutely. And it is that we spoke about that rising inequality, the history is replete of demagogues that rise up and say, yes, there's this rising inequality, let me show you how to fix it. And our last, our US example was, let me show you how to fix it. I'm going to give tax cuts to companies, and I'm going to give tax cuts to the highest tax earners. That will solve your problems.
I know.
So
it solves one set of problems maybe, but it doesn't solve the real problems. And, that's one of the reasons why this channel exists, because there's another agenda which is really, really important. And by the way, Cookie, I don't think we're going to see a rate cut later in the year until quite a lot. And there could be a rate hike in February because the inflation is still a bit sticky. So we'll see. We'll see. Very interesting year ahead, Damien, eh?
Yes. We're looking forward to our next talk at the end of the month, I think.
Yeah, look forward to that. And the links and things are below if people want to find more about the Wealth Funds and Nucleus Wealth. And, in terms of transparency and openness, Damien's a great example of showing how he thinks about these things, and the the information that's available there is pretty powerful. So I recommend going and having a look. Thank you, Damien. I really appreciate your time today, and look forward to next month, which we'll have another explore of what's going on, and who knows what things will be happening by then.
Yeah, great. I remember to dig in. We'll dig into the stocks next time.
We look forward to that. That'll be really interesting to look at some of the specific names. Yeah, excellent. I'll take you offline. I'm going to close the show. See ya. See ya. There you go, folks. Hope you enjoyed that, and always some really good value with Damien, and very interesting observations and commentary going on there. And next week, it's going to be me. I'm going to be sharing the latest on the modelling that I've done with financial stress. It's up again, so we'll be able to look at some of the data there and answer some questions and talk about postcodes and things. So that should be an interesting conversation. And just before I check out, the dogs are here. Still, they've been wandering around a bit, but getting ready for their lunch now. So they will, of course, be excited to have that and then go out for another walk. Anyway, I want to say thank you very much for spending some time with us tonight. We'll see you next week for another live show. And, of course, we'll be making shows during the week. Happy New Year for 2024. And keep in touch with us through the channel here, and also over on the blog and on Twitter. And I'll look forward to catching up with you soon. This is Martin North from Digital Finance Analytics, signing off. See you later.